Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term is about confidence and sentiment. In this month's LONGWave video, I'd like to discuss developments in our Strategic Investment Insights, or SIIs. As such, I would like to discuss those items shown here. I thought it important that we revisit some of the scenarios we outlined in last year's Q1 SII update to see what we can learn and possibly conclude. The first is our regular update discussion on the two major tectonic forces at play within the global financial markets. The forces of the end of the debt supercycle versus the forces of the global central banks now trapped in counter competition. Last year, we were witnessing the central banks all in the process of various stages of ending easy credit and tightening to various degrees. In our opinion, this would only quicken the pace of the natural process of the ending of the debt supercycle. We knew it couldn't last, would be nothing more than similar to tapping your brakes while driving on ice. Try to slow, but not put the car into an uncontrolled skid and sudden crash. What a year makes. The market volatility in Q4 2018 was simply too much for the Fed and the other central banks to handle. I think they were terrified. The worst December since 1931. We have therefore witnessed the Federal Reserve reverse its position in an unprecedented and historic fashion, as almost all central banks have stopped tightening, reversed directions, or accelerated easy money. The markets have reacted accordingly, with an unprecedented and historic recovery in January, the most since 1987, resulting in currently temporary stability. The Christmas Eve Nuchin massacre was what it took to call a central bank into coordinated action. Last year, we said we were in the early stages of a potential Minsky melt-up when we updated this chart. We have been using this since the Fed's taper program was announced. We have now updated that chart further. The credit cycle and GDP cycles have reversed, but the market has not, other than a temporary blip possibly in Q4. We showed this chart a year ago. It said the credit cycle reversal was beginning and the banks were preparing for it. I've always found that the banks are one of the best indicators to watch. When they start battening down the hatches, you should also. Well, a year later, we've got clear evidence, much of which we have shared with you in previous presentations in 2018, like the advancement in the turn in the business cycle, the late-stage shift in the credit cycle, the timing of shifts in various elements of the credit cycle, which our predictions turned out to be extremely accurate on. We have seen the banks tighten lending, with their willingness to lend, shown here, also falling quickly. What is very telling is that the primary dealers, or the money central banks, have become the dominant purchaser of U.S. Treasury bills, notes, and bonds. This normally only occurs for three reasons. One, there is a serious concern about liquidity and banks are preparing accordingly. Two, foreigners are not buying sufficient U.S. Treasuries at the auction. I refer you here to our 2019 thesis paper, De-Dollarization. And three, banks are expecting a downturn in the markets or economy or both. We actually may be witnessing all three presently occurring. Companies simply don't go and distribute cash to their shareholders in the form of buybacks or dividends at historic levels if they have good investments to make of a long-term capital nature. Also, the surge in bank payouts underscores that banks have limited opportunities to keep expanding their businesses profitably, so they're pumping out cash. Additionally, as primary dealers, they're hoarding, as I said earlier, U.S. Treasuries, and that has now taken on an absolutely immense proportion since Q4 2018. We know dealer holdings follow the rhythm of the euro-dollar squeeze. Maybe there really is no one buying all these U.S. Treasuries piling up on exposed dealer balance sheets currently. It now seems only a matter of time before the Fed not only ends its balance sheet unwind, but proceeds with QE4, or it may be called something else, in order to fund America's gaping budget deficit. However, whereas a new QE may be sufficient to monetize debt under normal conditions, it is unclear if even the Fed would be able to step up and monetize the tens of trillions in new debt that will have to be issued over the next few years if some of the new policies, such as the Green New Deal, actually arrive. What most concerns me, however, is that the U.S. is sitting on $5.9 trillion of U.S. government entity-held U.S. bonds. That's basically the IOUs sitting in things like this U.S. Social Security program. That money is going to have to be paid out. It can't be rolled over, and it's now in the process as 10,000 baby boomers retire per day to start to overwhelm the U.S. Treasuries. Foreigners can be expected to sell at ever-increasing rates, as I outlined in the de-dollarization thesis paper. U.S. banks can't handle any more treasuries without dramatically increasing excess reserve payouts by the Fed. And the unfunded pension tsunami will completely and very soon consume the U.S. Treasury's ability to fund U.S. government needs. Separately, the EU labor productivity growth has been almost non-existent over the past decade or so, with almost all of the EU issues having to do with supply-side problems. And as I've said many times, I think there's an imminent EU banking crisis looming on the horizon. Last year we discussed Trumponomics and what he had realistically achieved, or maybe more appropriately described as what Congress had limited him to being able to change. Trump had actually achieved a lot in terms of regulatory changes, business confidence, attracting business back to America, the beginning of renegotiating trade deals, but the real achievement was his tax reform. As such, as can be seen here, we saw a sugar high from those tax relief gains as we began 2018. But 2018 turned out not to be a continuation, but rather clearly a market that ran out of steam and was setting the stage for a reversal. This, however, was no longer about Trump, but rather about the global central bank tightening efforts to fend off the end of the debt supercycle, what Kondratia for the long cycle wave calls the winter stage. What we in reality are seeing is the after effects of QE. QE is fundamentally about increasing demand. That is, pulling demand forward through cheaper money, allowing demand to expand. Unfortunately, on the other side of pulling that demand forward is a giant hole. The longer QE lasts, the bigger that hole is going to be. The only solution when the hole arrives is more stimulus, which may temporarily buy a little more time or batten down the hatches for the inevitable storm. The central banks have decided on the former after surmising the magnitude of the potential global storm that they could see. Last year we examined the impact Trump policies were having on the U.S. dollar. We can see here that following his election and the realities of his policies regarding increasing the U.S. debt, the dollar steadily fell. In actuality, this was good for the global economy as well as U.S. financial assets, making them cheaper for foreign investors. That all changed going into last year as the Federal Reserve implemented its quantitative tightening policies regarding the central bank's balance sheet, as well as Trump's trade battle with China. Both contributed to a strengthening dollar, the former by reducing the previous effective currency debasement and the latter due to a flight to safety. As this chart suggests, we suspect this is all part of an across market's right shoulder. Trump's trade war, which has been as much about threat as the reality of the magnitude of actually implemented trade tariffs, have had a sobering impact on global trade. Corporate CEOs have prepared for the worst. The results, along with cyclical factors, are having a significant impact on global trade and GDP growth expectations. We have discussed in previous videos the big reversal. We believe we are in the process of going through, and this will no doubt play into it. On the other side of more short-term deflation, as supply is forced to be reduced, will be price inflation, leading to an inflation scare and potentially hyperinflation, remembering that hyperinflation is first, foremost, and always a currency confidence-driven issue. Our de-dollarization thesis paper, which this chart is from, lays out the seriousness of the global shift away from the US dollar. Even small reductions in its global use and need has profound impact on inflation expectations and the US economy. The fiscal wave on the left, associated with underfunded entitlements, a pension crisis, falling productivity, falling velocity of money, and shrinking money supply, are being met with the realities of global debt saturation. These forces are destabilizing the global financial system, which is supported by the dollar and its foundation being the risk-free measure of risk, U.S. Treasuries. Throughout this chaos, our strategic investment insights have performed extremely well. Currently, the 80 securities of the approximately 150 securities on the SII watch list have short or long triggers in place. This does not include the bonds and credit, nor the currency SII. Both of these have performed extraordinarily well and are not included, as the profits are about how investors actually chose to invest, whether they used the cash markets, futures, options, or ETFs. In the bond and credit area, the movement in high yield and 10-year Treasury were well identified by our macro analytic approach. The 10-year U.S. Treasury chart from Q1 2019 showed our projections had been sound as our diamond pattern tracked near perfect. We were looking for 2.85 on the U.S. Treasury, which we in early 2018 raised to a slightly higher number of 3.15. We actually reached 3.22, marked here as the head, in what we currently see to be another potential head and shoulders pattern. The drop to 2.65 was also well established in advance and posted regularly on MATA SII. The gap bar we felt needed to be filled before the right shoulder lift could get underway. 2019 will tell whether this is still the correct call. Last year we laid out our expectations regarding the US dollar. It was centered around our expectations that the US dollar would rise along the right side of this ellipse formation towards the upper red trend channel. We were looking for it to hit our circled high probability trading zone on the ellipse. We have had this chart in place since we completed the last ellipse shown on the left. The results have been quite amazing and profitable for this SII. We have achieved our high probability trading zone. We feel there is more to go in 2019, as we showed on this previous dollar chart, with yet another right shoulder drawn in. It appears the US dollar will reverse sometime in mid-2019, as will the US Treasury yield. We are nearing the final stages of the global credit cycle that will lead to a recession. Defaults will start rising, profit margins will decline and bottom, capital expenditures will decline, the dividends and their ratios will decline, buybacks will fall or be halted, M&A will decline, and cash flow rebuilds will become paramount to corporations and investors. As such, investors will shift to value and recession proofing. As a result, we've added 3 new SII sectors this year: healthcare, utilities, and consumer staples. We are not saying these are going to be the best performers, but rather will likely be something that our overall watch list will show needs to be somewhere in your portfolio based on our technical analysis timing tools. Remember, tops are a process. Major tops are often multi-year phenomena. We are seeing potential head and shoulder formations across equities, currencies, and bonds, as well as inverse head and shoulders in precious metals and commodities. 2019 is likely to be the year of the right shoulder. As I often remind us in these videos, remember, they will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of unsound money and fiat currencies. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2019 be an outstanding investment year for you and your family. I thank you very much for listening.